Shell misses forecasts, Q2 profits down at the West's second largest oil major as weaker oil and gas prices take their toll. Shell CEO Peter Voser joins me now. Good to see you again, Peter. Other than weaker oil and gas prices, how do you explain this big miss?
Good morning and thanks for having us. I think we had a good quarter with underlying production growth, but clearly oil and gas prices hit us. I think the difference to the market forecast is very simple. We have much more maintenance on the oil side, but also on the LNG side. So we had roughly $500 million of results impact from higher maintenance and some timing effects on dividends, and that actually explains the difference. So otherwise, we are pretty much in line with the market.
Can we talk about these extra planned maintenance costs? What are they exactly, and when did they happen?
No, it's during the second quarter we had our routine shutdowns, and it was mainly done in the Gulf of Mexico, which is crude normally, which gives you obviously a lot of high price upsides, and therefore we are missing those revenues. These are planned shutdowns. Two of them are back on stream now, and the third one is now in maintenance, so the third quarter will be affected by that as well. And then we had LNG shutdowns, so plant shutdowns, mainly in Nigeria and Australia, and that obviously took 5% of our LNG volumes out. And if you add all of that together, then you get to the miss number.
Peter, clearly there's some restlessness among the investors. Are you having a tougher time reassuring investors that your plans are on track?
No, I would say actually the opposite. In all of our discussions, the strategy which we are pursuing to grow the business through a very diversified option project pipeline which we have more than 20 projects on stream and another 30 to come, and we have a steady investment flow. We have a very competitive dividends. We generated $13 billion of cash in the second quarter, and therefore we have only an 8% gearing, so the machine is producing the money.
But they have been, these investors, or some of them, pretty unhappy about the dividend in the past, and on the back of this miss, I would imagine that's going to rub salt in the wound a little bit.
No, I wouldn't say so, because you had we have a very competitive dividend. We have always increased the dividend, or we didn't increase it during the financial crisis. We were one of the only companies. Yes, there were some higher expectations, but the macroeconomic side has changed as well. We take a long-term view on dividends. We take our growth into account, and we have a stepwise increase is our policy, and I think that's what we are following. So actually the discussion with the shareholders have changed quite a bit since the early part in the year.
Why did you abandon the Cove bid, Peter?
This was purely done on valuation views, and when the takeover panel actually decided to do this through an auction process, we had a look at it, and we clearly said that the valuation, based on valuation reasons, we are not going to go into an auction process.
But are these not the prices that need to be paid now? And I wonder just how deep you're prepared to dig to compete with state-backed companies.
I think, as I said just before, we have such a good developed pipeline of growth projects. We do not have to do things when they are not, in our eyes, giving us the profitability which we want into the longer term. Having global competitive pressure from other companies is something we are used to it. We have built through that time with this pressure this enormous pipeline. We have a very good filled exploration pipeline, so I think we can drive our own growth. But if there are more options available, we will try to compete for them, but I will just not actually change the profitability framework which we are using. So capital discipline for me is very important.
Would you not agree, though, that big oil is more on the back foot now than it was, say, 12 to 18 months ago?
No, actually, I wouldn't say that. And you can take 12 to 18 months, but you can also take the last 5 years. I think access to resources has actually changed quite a bit. Look at the revolution of unconventional gas and oil, which were driving in North America, in China, in Australia. We had the big finds in the Gulf of Mexico. Actually, the access to resources for us has changed. We are no longer only needing those which are maybe more difficult to get to because of national oil companies, etc. We have found our own oil and gas. So therefore, I think we are today, as a company, Shell, we are in a much better position to drive growth.
Quick question on the Motiva closure. How much is this costing Shell per month now, this closure?
We had a successful startup, but then there was a subsequent problem. So it is one part of the expansion which Motiva had to take out. The other parts are actually running of the expansion part, plus the normal refinery as well. We need to fix this, and this will take us into 13 in that way. We haven't given a forecast yet because we don't have completely at this stage the overview on how much we have to replace and what it's going to cost us. Motiva will update on that pretty sure later in the year, but we want to do a thorough assessment first and then come back and inform about that.
Okay, Peter, thanks for talking with us. Peter Voser, Shell CEO. More company news on demand, including an interview with BASF Kurt Bock from earlier today. That's available on the platform, of course, and on Reuters.com. And you can follow all of our programmes on Twitter @Reuters Insider. I'm Axel Threlfall. This is Reuters.